Should we worry that consumer discretionary is now the worst performing sector in the S&P so far this month?
I think there's worry in a lot of sectors. It's not just consumer discretionary. Look, Amazon, missing. The one thing you can't do when you're a growth company is miss on the top line. And even worse, you can't guide lower in your most important quarter. And I think that's what everybody's going to be looking at in consumer discretionary. Look, we've had an accident, in the markets right now. It's not life-threatening, but there's some bleeding out there and there's some injuries. But for me, right now, the elephant in the room is still the Fed and interest rates. That's what started this. That's what started the systematic selling earlier in the month. In the last couple of weeks, I've had an opportunity to speak with some insurance companies, pension executives, and they tell me once the interest rates hit a certain point, they saw an opportunity to de-risk, and they can now match future liabilities with corporate paper.
When you say de-risk, what do you mean? Get out of the stock market?
Get out of the stock
bond market?
They've been taking money out of the stock market because for the last 10 years they haven't been able to match liabilities with corporate paper. Now they can suddenly do that, and that's something that I got wrong. I really thought that 3%, even 3.5% in 10-year paper for U.S. Treasuries wasn't enough to cause an asset allocation shift. That was clearly wrong because it's happened.
So what you're saying is that when we saw 3.25% yields or near 3.25% yields, that was the trigger.
That was the trigger.
That
and that's
got a lot
of
institutional investors to take money out of, say, stock and other risk parts of the market and put it into things like Treasury and longer-dated corporate securities.
Because it's traditionally what they do. They usually use fixed income to match future liabilities. The last 10 years, they haven't been able to do that because the Fed has pushed them out. I got that wrong, and my concern now is, what if we get another 50 basis points higher? How much more comes out of the stock market because of that?
So let's talk about that, because it seems as though right now, given the current environment that we're in, we had talked about the idea that the Fed possibly raising rates too fast was the trigger for this particular sell-off. If we look at the safety bid for Treasuries right now, if the stock market continues to slide, it's which one? Which leads? Is the tail wagging the dog here? Are Treasuries now going to catch a bid and yields move lower because of the market volatility?
It's already started a little bit. It started last week. Look, I'm not the only one that feels this way. This is a conversation they're having inside the Fed. Even the Fed's own Neil Kashkari has come out and said they need a pause. It's not a race. We had almost comatose monetary policy for the last decade. Now we're trying to work our way out. We understand the need for normalization, but the pace has got to be slower. It could take us 5, 6, 7 years to unwind this.
All right, David, here's a question. President Trump has made it no secret that he does not like what the Fed is doing. All right, so let's say that he is right or he's not right. It doesn't matter. The point being, the Fed is not a political instrument. Yet, President Trump and his rhetoric has made it so that it feels like the Fed may have to pause just because the president has told them to do so. Is that the sense that you're getting from this?
The president is ill-informed here. He should not do this. As much as I agree with him, and I agree with what he's saying, the only thing more dangerous than an independent Fed is one that's become politicized. Not only that, the president is not accomplishing what he wants to do because he's backing Jay into a corner. They've got to raise in December. I don't expect a pause in December. Now, what I think they'll try to do at some point in the next couple of months is maybe walk back some of the rhetoric. Maybe you'll hear a Fed governor or two come out and say something. Maybe Neil Kashkari making that statement. Maybe he's the first one. Maybe he's, the canary in the coal mine. But at some point in time, the markets are going to tell them what to do. And the markets are screaming pretty loudly right now.